Market momentum and leadership.
Positive momentum continued in the markets through July, with both the US and Canadian markets hitting all-time new highs 2 months in a row. Look, many people believe that the rally is driven solely by technology and high growth, but we're actually seeing broader market participation. In fact, since April's Liberation Day, tech has indeed been the best performing subsector and was so again in July. But surprisingly, the best performing subsector for July behind tech this past month was once again utilities. On a year-to-date basis, the leadership is even more diverse, with the US industrials outpacing all other sectors, including tech. Looking at the past year, it's been clear that there's much more broad participation, and in fact, global utilities continues to stand out as a strong performer. We see the broader breadth of sectoral performance as a healthy environment. On a style basis, growth, megacap, and momentum continue to lead, while defensive areas outside of utilities, in value and dividend strategies in particular, have lagged. We do think having exposure to multiple styles in this environment continues to make a lot of sense.
Earnings, valuations, and economic data.
So as we move through the second quarter earnings season, now with 450 out of 500 companies reported for the broader markets, we're definitely seeing strong profit growth, despite some of the headwinds and headlines from a macro perspective. Particularly, we've seen strong growth in technology and financial sectors. Under the surface, though, some sectors are experiencing some margin compression, and was also highlighted on many of the corporate earnings calls that we were listening to. We think that this is worth watching closely and see if it's a sign of a broader trend that tariffs are actually starting to have an impact, or if this is more temporary and transitory. This also brings up the question of valuations. While market-wide multiples are elevated, continued double-digit earnings growth could in fact help normalize these valuations. But really importantly, on an equal weight basis, the market isn't nearly as expensive as headlines suggest. So that keeps our valuation views unchanged. We're slightly elevated with pockets of opportunity, and under the surface, certainly not as expensive as some of the headlines would indicate.
Policy uncertainty and economic signals.
So economically, we are seeing some mixed signals. The manufacturing and industrial production data does remain resilient, and the various measures of inflation appear to be contained. However, recent employment data did raise some flags. The US has seen the weakest 3-month non-farm payrolls since the pandemic, and the Canadian economy lost over 40,000 jobs in July, when the market was actually looking for a 10,000 gain. This does also highlight some of the relative economic strength of the US, and we think it does increase the likelihood of more aggressive rate cuts in Canada this year. More importantly, though, post the US employment data in early August, the US administration fired the commissioner of the Bureau of Labor Statistics and suggested that the data was actually manipulated. The politicizing and embedding a sense of distrust in some of our key economic institutions and data, we do think adds some risks. Despite the market looking beyond many of the policy-related events and risks that we've seen so far this year, we do think that the policy remains a very key risk and also remains at high levels.
Back to basics and a look ahead.
So we track the VIX index, which is a measure of volatility, and you can see that it has compressed significantly in recent months. However, we do often see a seasonal increase in September. We know that valuations alone don't cause market correction, and the same is true for market bottoms. Just because valuations are cheap doesn't mean that stocks have bottomed or necessarily that they'll outperform. That being said, we do see some opportunities in sectors that have lagged, and a great example of that is the healthcare sector, which is now trading at one of the widest valuation spreads relative to the broader market in decades. Of course, being inexpensive is not the short-term catalyst in and of itself. We have, though, published several insights on our website about some potential catalysts for rotation, and we look for some of these through the fall and for the sector to regain some of its relative strength. As we get ready for the back to school, we think it's also time to get back to basics for a lot of people looking at investing right now, diversifying geographically by sector and by style. For example, HHIS and HTA are focused on the higher growth areas in the market, and that factor continues to perform very well. While more defensive areas like global utilities also are performing well, we think complementing some of the growth with other factors like low volatility and even some income solutions and diversified one-ticket solutions like HVOI and HDIF are well-timed, and we would reiterate the view that the buy the dips mentality that has persisted in the market really since April is likely to stay in place should we see any pockets of volatility as we come in through the fall.
Subscribe to Harvest ETFs Insights. Join us and stay informed.